Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Hello, everyone. You join us for another packed episode of Company Results and Analysis, starting today with car testing outfit ABDP, which reported half-year results this week. Can it continue to perform well at a time when the automotive industry is once again facing a string of pressures, including, yes, tariffs? Chris Akers joins us to discuss shortly. From there, we'll shift gears and look at our big read this week on the subject of survivor shares. Which companies are best placed to withstand an economic slowdown, and more to the point, best placed to come out the other side ready to roar ahead? James Norrington will detail how to find them. To wrap up, we will be returning to the world of preference shares, which, while they're beloved by income seekers because of their massive yields, may not be long for this world following Aviva's successful attempt to cancel some of its prefs this month. Jemma Slingo will talk through that, plus some breaking news on this front from NatWest as well. Let's get going with ABDP, though. Chris, as I say, a slightly perilous moment for automakers, albeit when isn't it in some ways. The company itself, though, firing on most, if not all, cylinders in these figures.
Yeah, that's right, Dan. As you mentioned, ABDP is a car testing company. It's listed on the AIM market. And yeah, it's quite a strong set of first half results this week, with really no signs of a trading slowdown against obviously a backdrop of pretty significant macro and market uncertainty. So in the first half, revenue was up 11%. Pre-tax profit was up by over a fifth. The order book came in ahead of last year, and the company said it expects to hit the analyst consensus for profit for the full year. Just on revenue, the sales were up across all divisions. At the biggest units, which is testing products, sales were up 7%, and that was thanks to growth in driving robots and an electronics testing solutions acquisition. And the company's smaller units actually grew revenue more quickly. So testing services were up by 21% ahead of new regulations coming in the US, and simulation sales were up 15% on improved motion platform trading. And the company also posted its first revenue in the half from ABD Solutions, which is its new technology accelerator business. So yeah, a strong set of results overall.
There's lots of things the company does under the testing umbrella, if you will. As you say, there's split between products and services. There's the autonomous driving testing as well, which clearly is something that a lot of the industry are pinning lots of hopes on. Let's talk, though, about the medium-term strategy, because it set out some goals on this front in November. How's it begun setting out on that path? What are those goals, first of all? And then maybe we can get into a little bit more into what it does and where it does it later on.
Yeah, that's right. So the company set out a new medium-term growth plan back in November, and its goal is to double revenue and triple operating profits over the midterm. And to do that, it's hoping to achieve annual organic revenue growth of around 10%. It wants to get the operating margin up to 20%, and it's also planning to make some more acquisitions to help with this. And looking at sort of trading in that context in the first half, so organic revenue growth came in at about 8%, adjusted operating profit was up by over a fifth, and the margin was up by about 160 basis points to 18.6%. So I think it's fair to say that progress is being made towards those targets, and it's a good start in this half.
Let's talk about the first elephant in the room, which, as for every company at the moment, it feels like, is tariffs and the impact that they might have. Clearly, in the automotive sector, you've got a 25% tariff being levied by the US, albeit that, like everything else at the moment, signs that may be weakened in the past couple of days from some press reports. At the same time, you've got these potentially inflationary pressures coming from tariffs across the supply chain, and supply chain issues too, not just in the automotive sector, but everywhere. Certainly a company like ABDP, which, given all the specialized testing and working with simulators and robots, things like that, it's going to require a lot of very small components and things like that to do those things. So there's all kinds of potential knock-on effects. That said, the company struck a relatively optimistic tone in these figures on the subject of tariffs as a whole.
Yeah, it did. So, I mean, yeah, management's sort of position on tariffs is that it expects quite a limited direct impact from the Trump levies, but it is mindful of obviously possible indirect and inflationary impacts I think it's important to say that the company revenue base is quite diversified. So revenue spread across several key markets. Around half of it comes from Asia, a third from North America, and a fifth from the UK. It's also got around 150 customers. So that diversification, I think, is helpful in the tariff context. Yeah, as I mentioned in the piece, some analysts have argued that the company is actually better positioned than some of its European peers when it comes to tariff impacts as it sells to the US directly from the UK. And that assumes that European tariffs will ultimately be higher than those on the UK after Trump's 90-day pause ends. But I don't think that's an outlandish suggestion by any means.
This is based on, I think, a couple of companies. There's a simulator company, something Grade, isn't it, which is a European company, and there's 4Active as well, which does track testing. So those are, I think, Panmure Liberum flagged as two big competitors to AB Dynamics. But as you say, yes, because they're in Europe, which ostensibly faces a 20% blanket tariff versus the UK's 10%, albeit that 20% has been reduced to 10% during this 90-day pause, and who knows if it'll go back up, we'll see. Then AB Dynamics is better positioned in that regard if that plays out because of its UK positioning. So that's a sort of feather in its cap, one supposes. Let's talk about the other headwinds, though, or possible headwinds, because this is really the challenge facing AB Dynamics investors and the company itself for a while now, isn't it? In that operationally, it's pretty strong. It has a good story. It has a good track record at doing what it does, and the tailwinds for the business would, in theory, appear to be quite strong. You know, you've got a sector which is going through this big transformation with not just the arrival of electric vehicles, but also of autonomous driving type vehicles. That means a lot more testing is required, a lot of simulation, a lot of different things which AB Dynamics can provide. At the same time, though, all those changes do mean, as we know, that a lot of car makers are under massive pressure, be it from the likes of BYD and low-cost Chinese rivals, or be it from the ability or inability to shift their business models. So there's a question of whether these two impulses, how they interact with each other, and whether the demand for AB Dynamics services can remain consistent throughout. I mean, it does seem right now that it can, but maybe the market is not quite convinced.
Yeah, I think that is a very important point. Operationally, trading has been strong, and you have a lot of growth drivers that are supporting the company's prospects. And the results themselves this week sort of highlight that underlying trading is strong and it's dealing with macro uncertainty relatively well so far. But with these sort of wider trading and market issues have hit the shares, it's important to say. So the shares are down around 10% so far this year, and just 3% over the last 12 months, which is fairly resilient given headwinds, I'd say. And on the wider sort of auto market point, I think something I wanted to mention is one of the key risks for the company is automakers cutting R&D spend as a result of the sort of tariff and economic weakness. And that's something investors have to bear in mind. But again, there's no signs of stress disclosed in these results. And as those automakers look for efficiencies and ways to protect market share in what is an increasingly competitive industry, I think that will support that R&D investment and support the company's longer term prospects. You mentioned BYD obviously putting pressure on European incumbents who are having to invest to protect market share. So I think a mixture of tailwinds and headwinds to consider, but the company's in a relatively strong.
Yeah, that seems fair. There's also efficiency gains at AB Dynamics itself that it was talking about in these results. Can we say a bit more about what it's been doing to try and insulate itself?
Yeah, absolutely. So yeah, efficiency gains were pretty obvious in both the uplifts in operating margin and gross margin. The gross margin was up by around 190 basis points in the half. And there are a couple of things going on here. The company has a new enterprise planning system, and that cuts customer lead times and improved product quality, it says. It's also looking at more product standardization and simplifying supply chains further to improve capability and capacity moving forward.
What about the valuation then, in light of all these things? Still priced as maybe a sort of a quality industrial, a relatively high level, but not that high compared with the recent past. And given, again, factoring in all these issues we've spoken about, there's still some attraction there, perhaps.
Yeah, I think so. So the shares trades on about 22 times forward consensus earnings for 2026, and that is cheaper than it's been in recent years. It's actually a bit of a hard stock to compare against at least listed competitors, given peers are mostly private and there aren't really any sort of true pure play listed peers, I'd say. It makes more sense to look at the company's valuation on a divisional basis. For example, if you looked at the simulation unit, there is a peer in the US called ANSYS, and that's a bit more expensive than AB Dynamics. It trades on about 24 times earnings for 2026. Yeah, a bit of a tricky one when it comes to the valuation against listed peers. I think sort of the rating is undemanding given the resilient trading and growth prospects we've spoken about.
Well, we'll see if it can keep up that fairly admirable performance in light of what may be coming down the line, but so far so good on that front. Let's turn now to our big read of the week. James Norrington, you have written this piece. It's well timed, talking about the kind of shares that can survive economic uncertainty and that can come out the other side prospering. Why don't we talk a bit about sort of the thinking behind the piece in a bit more detail to kick things off?
Well, originally, Dan, as you know, we were talking about doing a turnaround shares piece about sort of companies that have, through change of management, change of strategy, have greatly improved their prospects from what they were in the recent past, which obviously is a great way of bottom-up stock selecting, and investors can make a lot of money on those companies. The best example of recent years being Rolls-Royce. But unfortunately, our friend in Pennsylvania Avenue blew that out of the water, and when everything sort of can be a turnaround stock when everything's pulled down. So we really sort of changed the hypothesis of it to looking at, which companies are getting their own house in order and can be well placed to be agile when there's a big macro event and come back strongest when all ships don't rise at the same pace on a turnaround. So that's kind of the thinking of it.
We'll come to Rolls-Royce because we do talk about them in this context too. They are, in some ways, the kind of company you could look at in a time of economic uncertainty, perhaps, or at least you can look back to what happened in 2020, or at least in 2021, 22, after they had gone through their most perilous moment, as an example of the kind of business that can, as I say, come out the other side really fighting fit.
I mean, no two crises are the same. This particular one is a little bit tricky because we're dealing with dismantling of the economic order since World War II. That's something very hard to model for.
With a slight understatement there, it's quite tricky.
It also affects things on macro consideration, an asset allocation consideration, the dollar as a haven asset. And also, it's very material for supply chains of many companies who've actually have been doing a good job based on the previous set of assumptions that existed, at least since the end of the Cold War about sort of globalization, even though perhaps COVID in a way did make people a bit more resilient with looking at supply chains because that was one of the things that was affected massively by that particular problem. But this is really where the bottom up comes in, is we're looking at, I kind of think you've got to look at companies that are lean, are good at getting their own house in order, because some of the traditional defensives are going to have issues as well. I mean, utilities aren't particularly affected by Trump tariffs, for example, but they've got their own problems. People always used to say utilities were tense, but things like water companies have been appallingly managed for years. They're not the defensive, particularly because they're loaded up with debt. They're not the sort of the safe havens that they once were. Other companies, even consumer staples, obviously affected massively by global supply chains. So really, it's a time to be a stock picker now. And really, we're looking at agile companies that are capable of making changes quickly. You want to look at efficiencies in terms of sort of their asset turnover, which is the revenue that they make on productive assets. You want to look at companies' working capital cycles, which is how efficiently they're managing their day-to-day capital allocation and investment. And in the mid to longer term, needs to be done slightly carefully because you can chuck the baby out with the bathwater. Look at return on invested capital, what the track record of management has been in that regard. And then, of course, you're looking at measures such as the general liquidity of and the cash position of companies, how good they are at converting operating earnings into cash, their cash conversion cycles, how good they are at getting paid, what their inventory management's like. And also, you're looking at, how sustainable long-term are their capital structure. So a lot there.
Indeed. Let's stick with Rolls-Royce just because it's good to sort of put it in that context, perhaps, and people can relate to what they did. No two crises are the same, and clearly at the start of the pandemic, they had a big rights issue, which you can't really blame them for because their entire revenue source had dried up. People weren't flying around. After that, though, there were some things they were doing right in terms of what was going on at the business, under the bonnet, if you will, which really helped prepare the ground for this massive share price rally we subsequently saw. Some of those things you've touched on just now, but can we talk a bit about the kind of things they looked at say in terms of revenue recognition, things like that, the way they righted the business and some of the things that were going wrong pre-pandemic were being solved at the same time as they were dealing with this massive crisis.
When something sort of comes completely out of the blue, like COVID, companies are going to raise capital, and actually that's not something to hold against them. The ability to conduct a rights issue successfully, to raise debt and secure long-term debt, cheap funding, that's part of good management. But what happened a little bit in the pandemic, early on in the pandemic, some previous bad management obviously came home to roost with Rolls-Royce. They had to have charges for previous poor sort of revenue catch-up charges where they'd been recognising revenue from contracts, because obviously a lot of their revenue comes from after-hour engine care. Well, and the new turnaround really started, obviously, we've written about this a lot. The new CEO, I won't attempt to pronounce his name on the podcast, but he's done a fantastic job. And one of the things it is improved the contracts, which much more of a focus on time of engines on wing, which also leads in it's much more transparent in terms of being able to recognise revenue, but also it's good for the velocity of cash flows. And when they've had the, no pun intended, the tailwind of a recovery in civil aviation, that's something that they've done well themselves, along with a favourable macro backdrop to really improve the cash flows of the business. The other thing they've done very well is they're looking at their costs. They've rationalised their working capital expenditure. Some people do worry a little bit that they've cut it close to the bone. But again, I mean, it means that they're efficient and they're agile. So if there is a shock, they're just a better run company than they were 6-7 years ago. And you can see this in the convergence of some of their cash flow metrics as well. As I mentioned, the ability to have their free cash flow to the firm, which is basically the operating cash that they're generating, and how that translates to everyone with a claim on the business, debt holders as well as equity holders. That's converging with the free cash flow to equity, which obviously gets boosted by the cash you raise from borrowing. And that's a sign of a company that is going in the right direction, that trend.
Yeah, those cash flow metrics are always important to watch, aren't they? And certainly a big part of the reason as to why Rolls has started faring a lot better with shareholders over the past couple of years. Another company, Melrose, has had a difficult time of it more recently, but there are some signs there that it too is righting the business in a way that could bear fruit down the line.
It's another company in the same industry. It's good we got Chris on the call as well, as I think he's written ideas on them as well. It's part by both in his beat. But again, it's a company which has strong customer relationships. It makes key components. This is one of the things actually to look for with companies going through any difficult time is companies who are essential to its customers. Obviously, it's in an industry with structural drivers with civil aviation. And again, it's another company that's been on a cost rationalization drive, but it's also been making investments in, again, looking at the trends in the industry, the time on win focus of Rolls-Royce, which is one of its customers. It's cornered. It's also Safran's another big customer, and GE Aerospace. But they've invested heavily in strengthening their engine, fan, and blade repair capabilities. So they're looking at their medium-term investment and doing a lot of the right things. And as those operating margins are showing signs of improving, and as efficiency, to watch the progress with the efficiency changes they're making, you want to be looking at things like how their cash conversion cycles, which is basically looking at their management of inventory, how long it's taking them to get paid and how long they're taking to pay suppliers. And as that gets shorter, you expect to see the operating cash flows improve. And so they're saying a lot of the right things and putting a lot of the right things in place. And then ultimately, you will see that free cash flow to the firm improving and converging with free cash flow to equity, which is a sign of a healthy business.
I won't bring you in, Chris, but I know you maybe you're feeling a little bit aggrieved about some of the Melrose sell-off earlier this year, even pre-tariffs, because that wasn't really justified by the fundamentals, it seemed, when it reported back in February. But yeah, there's lots of reasons to be positive there, as you say, James. Let's finish by returning to the tariff subject in particular and think about what kind of things investors should be looking at there in the context of what we're talking about. Things such as input costs, of course. It's very hard to delineate and work out some of the way these things are going to factor and reverberate around the business, but that's something to look at, and currency management as well.
Supply chains, I mean, this is the big fly in the ointment with the aerospace industry, both the two companies we've mentioned. Global supply chains obviously threatened by trade wars and tariffs. Again, perhaps because because of the pandemic, they're still reeling from the pandemic, but maybe in a way that's built some resilience in and or at least some planning for this. It's been front of mind for some time. But again, so broader with all industries, you've got to think now. about input costs and the fact that some companies with manufacturing businesses with supply chains where you have some things built in one country and another component in another, and then they put it together in another. You've got several charges on the way in and out here potentially, which is one of the big criticisms of some of the rather reductive thinking on tariffs, particularly for the US auto industry. So really, what you want to think about, where are the customers and who are the suppliers for any company you're looking at investing right now, and who are the big contracts with, and how are those big contracts likely to get affected? And also on the operating side, how much is this going to increase fixed costs and increase the operating leverage of the company? Because you could have, on the one hand, you could have a hit to demand because it's you're having to try and pass on these costs, and you could also have a hit to your costs. So you're sort of stuck in a bit of a vice, which is going to be squeezing your margins, and that's something to be very aware of. And then from the financial perspective, you've got currency and treasury management. I mean, all companies manage their treasuries carefully, international companies, and there'll be hedging risks. But when you see very fast sell-offs, and certainly if you're holding certain, particularly financial companies are holding sort of certain types of long-dated bonds as collateral, that's going to affect some of their trading operations, and it's also going to attract potentially some of their liquidity as well. These are things to look out for. Again, this is probably for a future piece, is looking at how translation risk with currencies. There's functional currencies, reporting currencies, and the local currencies of subsidiaries, and there are different accounting rules depending on where you report and how you report that, and that affects financial ratios and valuations. So there's a lot of moving parts to be aware of. And then, of course, the final one is obviously inflation and interest rate uncertainty. We talk about companies making good use of their capital structure, but if there's rollover risk with having to refinance debt, structurally higher inflation because of trade barriers, that has an effect as well. There's a great many moving parts that you've got to be aware of.
For any business, I think that's fair to say. But this piece, as hopefully listeners would have gleaned, does a good job of relaying some of that information and talking about how investors can think about companies in ways perhaps that we should always be thinking about them, but certainly come to the fore at times of stress. So as I say, do have a look at that online in print this week. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. We're going to return for the final segment, though, to a topic we discussed a couple of weeks back, which is preference shares. Back then, Aviva was about to hold a vote on the cancellation of its shares. It's now done so. Jemma, why don't we start just by recapping why exactly it wanted to cancel these shares and why they've been so prized by investors for so long?
Yes, it might be handy just to give a bit of a recap of what a preference share actually is for anyone feeling a bit puzzled. So basically, they sit between ordinary shares and bonds. And one of the big selling points for investors is that they provide what should be a fixed dividend. So retail investors love them, particularly older retail investors who want that income for later life. Companies don't like them, basically, because as this suggests, they're a very expensive form of funding for them. And lots of the preference shares that are still in circulation today date back to the early 1990s, which some listeners might remember, sort of extremely high interest rate backdrop, and preference shares actually seemed quite a reasonable way of raising money for companies. And now, obviously, that backdrop has very much changed. So we've got companies that still have these preference shares and issues, basically trying to get them off their balance sheets. And Aviva is the latest one to attempt to do it.
And it has now done so. It was a fairly comprehensive vote in the end, perhaps surprisingly so.
Yeah, so it was in a couple of stages. So you had the institutional shareholders first, who were very much in favour of it, and then the retail shareholders. But in general, there was a lot of support for cancelling these two sets of high-yielding preference shares. And it came sort of 7 years after there was a massive hoo-ha when Aviva was trying to cancel the same sets of shares, but there was a big backlash from investors and from the regulator. So I imagine they are feeling sort of quite pleased with themselves at the moment and breathing a bit of a sigh of relief.
There has also been, just this morning as we record, some moves of a similar nature, albeit at a smaller scale, from NatWest as well.
Yeah, you called it breaking news earlier, which may have been a little bit too enthusiastic.
Well, it's out today, it's breaking news.
That's true. So NatWest had its AGM yesterday, and they voted to basically get rid of two very small tranches of historic preference shares. So the deal in itself, not hugely exciting. Not many investors will be impacted by it just because of its size. but it's quite interesting as it could be a sign of things to come. So readers of our Bear Ball column might remember that there are other NatWest prefs floating around, sort of specifically these 9% non-cumulative ones. And there's actually quite a lot of those shares still outstanding. And now we have this situation where the management team at NatWest is clearly thinking about preference shares. They're wanting to get rid of them off the balance sheet. So, I don't know, holders of those 9% prefs might be thinking, oh, I wonder if there'll be any attention drawn to those anytime soon.
Well, Aviva obviously had to pay a premium to cancel the shares, as we say. It didn't try to do that in 2018. It didn't work. There was RSA last year, which you wrote about at the time, James, saying that might spark a flurry of other cancellations, which does appear to have started to happen. But there are still other preference shares out there for now in existence, all of which offer fairly chunky yields as per their original ethos.
That's true. So it's mainly sort of banks, insurers, and utility companies where you can find them. But they are sort of a dying breed, I would say. But if you're thinking about names like NatWest, as we mentioned, Santander, BP, there are prefs out there if you know where to look. But something you always need to be thinking about is these are quite esoteric. They're not liquid. They're not necessarily that well understood by the market. So it's not like buying, a normal mid-cap. You might get lumbered with them and not able to get rid.
Indeed. That said, there are some potential tailwinds for these instruments as well, as with many bond-like instruments, in the form of interest rate cuts, perhaps, coming down the line.
Yeah, so they act like bonds, essentially. So when interest rates go up, their prices go down and vice versa. So if we're now in this strange situation where interest rates might be coming down a lot quicker than everyone thought because of these recession fears, we might see some interesting movements, but we'll have to see. I think very much the mood at the moment is that companies do not want these things on their balance sheets. And I should have mentioned earlier, there is a regulatory change coming as well, which is sort of increasing the sense of urgency in boardrooms because it's no longer going to count as sort of capital, sort of prudential capital on their balance sheets anymore. So there's not much incentive to keep them.
In that context, really, to me, emphasizes the fact if I were holding these shares, I would not vote for cancellation. A, because of the qualities of them, the income you have. B, because companies are going to get more anxious up to 2026, and who knows, you might come back for a better deal, which again, I think is what you were saying last year, James. So we'll see what happens with more of these. I suspect, given the regulatory impact and the dislike in boardrooms, as you say, there may be more cancellation attempts, but I think it would make sense for people to hold out. If I were holding a preference share, that's what I'd do. This is not a financial advice, but just advice to myself. If I could travel back in time and buy some, I would. Anyway, I think we've come to the end of the show on that unusual conclusion because we have run out of time. So thank you very much to Jemma, to James, to Chris, and to our producer, Vic Thornton. We'll be back next week with another Companies and Markets show.